We really prefer the business model of the oil sands over the business model of U.S. shale.
The case for owning real-world assets. We talk about why investors should be increasing their exposure.
10 years ago, we were in a NIMBY world, which was not in my backyard. Starting like 9 years ago through today, we think the world shifted to the bananas world. Build absolutely nothing anywhere near anything.
We speak to Tyler Rosenlicht of Cohen Steers to talk about infrastructure and natural resource investing.
We think that there is a huge value unlock opportunity if rail M&A were to happen.
Are there more deals to be done? How do you think about valuing a company like Cameco? And tell me why it's maybe not overvalued. But how do you think about owning the pipes here?
Yeah, it's like asking me which of my children's the favorite, right?
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. Hey everyone, welcome to a new episode of In the Money with Amber Kanwar. Investors are finding their way back to the market, spooked after the Iran war. They're crawling back actually to tech stocks. But in this episode, we speak to Tyler Rosenlicht of Cohen Steers. They specialize in real world investing. So infrastructure, natural resources, real estate. We don't really talk about real estate because Tyler's focus really is on those infrastructure plays as well as natural resources. And he says that investors should actually allocate on the higher end of their portfolio exposure to this very sector. And he lays out the case. He says, we're not done with inflation. We're not done with a complicated environment that he thinks is going to persist for the next 20 years. He says we're in the middle of a regime shift that does include real-world assets outperforming, maybe not in the next month, but definitely over the next 20 years. Let's hear him out. Let's get into it. Tyler, thank you so much for joining me on the podcast.
My pleasure. Thanks so much for having me here.
So I'd love to get to know you a little bit. You and I haven't had a chance to speak with one another yet. You're a U.S. fund manager, and you traffic in an area of a lot of interest to Canadian investors, natural resources and infrastructure. Tell me a bit about your universe and how you approach investing.
Yeah, we'd love to. So we're a long-only asset manager at Cohen Steers. So we focus primarily on listed real assets and alternative income. Listed real assets being REITs, commodities, natural resource equities, and infrastructure, which are obviously the two strategies that I spend my time looking over. They're very different worlds, and they sort of serve very different objectives for investors. Infrastructure, at its core, is low volatility, downside protected equity returns, where we are trying to find high quality businesses that are very predictable, that have good inflation beta, that generally we think can perform really well, particularly in periods of high inflation or sort of macro concerns and so forth. For infrastructure, I think about it as the cute subsectors. So we're investing in communications. So this is things like cell towers, data centers, and satellites. It's utilities, electric, gas, water, and then renewables. It's transportation infrastructure, so toll roads, marine ports, airports, and so forth. And then E for energy, but it's really just the midstream part of energy, kind of the pipelines, storage, and transportation. But again, high quality businesses, predictable, that we think are actually seeing very strong economic growth and sort of accelerating growth trends.
Does it
The natural resource, sorry, go ahead.
No, well, I was just going to ask, like, when you're such a, sector focused specialist, does it require you to kind of always hold a specific view, like always be bullish that? Or are there times, you mentioned these are meant to perform well when the macroeconomic environment is maybe a little bit more stressed, inflation is present. If we're not in that kind of environment, how do you pivot?
So it's a really good question. So I'd start with, we think infrastructure and natural resources, for what it's worth, both deserve to be in portfolios at all times. We think that they offer sort of diversification benefits. They improve the risk-adjusted returns of your portfolio. I mean, if you go back to 2022, equities were down 18%, fixed income was down 16%, infrastructure was down 5%, natural resource equities is up 10%. So what we think is part of a balanced, diversified portfolio includes an infrastructure allocation and a natural resource allocation, honestly, a real assets allocation at all times. Now, that does not mean it should be static. So maybe your investors or investors out there would say, hey, I think real assets or infrastructure should be a 5 to 15% range. Sometimes maybe they want to be at 5 or 6. Other times they should be at 14 or 15. But we think there's always a place in portfolios for these things. Here and now, we think we should be at the high end of those ranges, just given where we are in the cycle. But yeah, to your point, there's going to be times when both underperform equities or fixed income. That's not to say you shouldn't own them. It's just to say that, hey, they're providing a purpose in your portfolio that's maybe not paying off in that period, but will pay off or could pay off into the future. The other thing that I would add is, for us, we are active managers. So we are not statically holding a portfolio of 30 or 40 or 50 stocks. We're trying to go and identify where we are in the cycle, who's best positioned, and generate better than benchmark returns. And so for us, it's very active, always looking at the best opportunities. And we think that's even more important because you can see good returns throughout the cycle if the active manager is able to have a process that identifies good performance.
Tell me why we should be at the high end of the allocation right now.
Yeah, I'd say we think the next 20 years are going to be very different from the last 20 years. We can get into this in a lot of detail, but we were in a globalizing world. We think we're in a deglobalizing world. We think there's a lot of inflation impulse out there. We think we've exited from a commodity perspective what we talk about as the era of abundance and entered what we characterize now as the era of scarcity. You look at the last 2 decades, inflation had 2 characteristics. It was very low on average, and it wasn't volatile. Inflation averaged 1.5%, and it ranged from 0.5 to 2. We think the next 2 decades is going to be different in that it's going to be a lot higher on average, and it's also going to be very volatile. So there's going to be periods when inflation's accelerating a lot, periods when it's decelerating a lot, but in general, it's going to be significantly above where it was for the last 2 decades. And so in that sort of world, we think investors are going to benefit from having sectors and investments that do well, particularly when inflation surprises. You add on to that, valuations today are actually pretty attractive. I mean, the natural resource equity side, a lot of these stocks are up 75% in the last year, but they trade at lower multiples today than they did 12 months ago, because gold prices are up a lot, uranium prices are up a lot, copper prices and energy prices are up a lot. And so you get the portfolio benefit, you get this sort of changing cycle, and you're actually not paying a lot to get access to these things relative to equities and relative to fixed income. So, as we look at the tea leaves into the future, it's really hard to predict what's going to happen for the next month, quarter, and so forth. But as we think longer term for asset allocators, real assets broadly, we think are really well positioned.
It's interesting. And we've certainly seen that outperformance, call it over the past year or more than year, real world assets outperforming, common stocks as a benchmark. And I know you're talking about this call for the next 20 years, but if I can narrow the focus to like the last 15 days, I think it's really interesting to watch the reaction in the market. Since the market bottomed on March 30th, the instinct has been not to go into energy, which you would think, hey, shouldn't that be a beneficiary of higher oil prices stemming from the war? The instinct has been to go back to tech, which has lagged. What do you make of that? What do you think is driving that? And what's to say we just don't go back to that old faithful, because tech is still an earnings growth story. It's a spending story, but earnings are still growing too.
Yeah, I think obviously it's really hard to talk about what the market's doing in the short term. I think in hindsight we'll sort of get better information, but sentiment and so forth can really affect things. As we think about the conflict in Iran itself, this is what I would have said 2 weeks ago, and here we are 2 weeks later, and we still believe it. If you think about this conflict as sort of a flight path, the conflict plane took off and got to altitude very quickly. We think in the third week of March, it sort of reached cruise and started the descent. And so here we are a few weeks later. And what I'd say is, even though the Strait of Hormuz is not fully open, even though there still is conflict, we think we've passed the peak uncertainty and the peak sort of challenges with the conflict. Now, it's not to say things can't get worse. These are things that I say with somewhat low conviction because you're trying to predict geopolitics. But where we are here and now, we think the conflict plane is continuing its descent and will land sometime in Q2. I would say that is a very short-term relief for investors, because in the second week of March, there was real concerns around real stagflation, recession, bad things associated from the supply chain impacts and so forth that you get from this. So over the last few weeks, things have thawed. And I think in the short term, that's a good thing for equity markets. And it's a good thing for the stuff that's worked, because we're going a little bit back into the world of things are okay. For me, as I think about what the next 6 months hold, not the next 20 years, the next 6 months or the next year, we do think that the conflict is slowflationary. Relative to February, we think inflation is going to be a bit higher. Growth is going to be a little bit lower. It's not stagflationary yet, but that is a sort of negative impulse for broad equities, a positive impulse for real assets. We're arguably a little bit biased, but that's us trying to be objective. And so as we look at how the next quarter or two is going to play out, I think the valuations for sort of the old economy or the halo stuff still look really good. It's not a surprise you've seen the relief rally, but I kind of think the makings that you need for it to continue for a really long time, I think I'd say, hey, I'm not going to position that way today.
So you think maybe the worst of the crisis is over. So maybe you get a relief in some of these other stocks like software, but ultimately we're in an environment where inflation remains elevated. Did I capture your thinking?
Yeah, I mean, the best way that I can sort of make up some sort of numbers around how we think the world is changing is for the last 40 years, the global economy adopted the Toyota just-in-time manufacturing model. All the inputs that we need for economic growth and consumption, we want to buy them from the cheapest source of supply. We want them delivered immediately when we need them. And I'd say that model worked for a really long time. And then COVID hit, and we said, hey, the supply chain is pretty concentrated. And then you had the Russia-Ukraine challenges, and we'd say, hey, again, we realize the supply chain is way too concentrated. And then here we are with oil, a major global commodity, and we realize that one strait in the Middle East can massively disrupt the movement of energy and cause a huge change to diesel prices and jet fuel prices and aluminum prices and other things. And so what we think is, the world is recognizing that the geopolitical dynamic is changing, and your willingness to operate the global economy on this just-in-time model is going to be a lot lower going forward than it's been. I think almost by definition, that's going to be inflationary, because it's no longer low inventories from the cheapest supplier. Now maybe it's, I need some redundancies. I need to have higher inventories. I need to be able to weather geopolitical challenges. And also, maybe I'll pay a little bit more to make sure that I can get the inputs and the goods from myself or from someone that I really want to transact with. And so as we think about how this is going to play out over time, we do think that that's inflationary from the commodity economy perspective, and it's good for commodity businesses and so forth. We'd also sort of say, hey, like a lot of things out there's a lot of governments that continue to print money and spend. That is inflationary. And so, yeah, we do think the cycle has dramatically shifted from where we were, the last decade or two.
Can I take a bearish view of what that inventory landscape means? Is that maybe we move from like a deficit very quickly to supply glut, and then all the, we're sitting on all these barrels. Let's talk about it from energy's perspective. And then, we don't need them. And so that results in a fire sale, right? Like you see it as a bullish thing because people are going to be buying to stockpile. I can easily flip that and make that a bearish argument.
Yeah, so the two ways that I would, listen, I think all perspectives are valid and that could definitely play out. I'd say the two things that I would push back against that would be one, typically in commodity markets, the cure for high prices is high prices, the cure for low prices is low prices. What that means is prices go up and supplies increase, the market rebalances and prices come down. We are not seeing the supplies increase reaction function today. So actually last year, copper prices were up a lot. Many copper producers, when they released their 2026 CapEx budgets, released lower budgets than the market expected. So even though you've had this high move in prices, you're actually not seeing an increase in supply. Honestly, a lot of the commodity economy businesses have destroyed a lot of value for the last 15 years, and shareholders do not want them to increase supply. They want the cash to flow back to themselves and they want to be able to allocate it on their own. And so what we'd argue is, well, the reaction function has been broken. It's a lot slower. And so we're not seeing the increase in supply yet. Will it come? Sure. But at the current pace, we think it's going to take a long time. The second thing just on it is this glut. When you look around the world, there are very COVID-like austerity measures taking place in some very energy-dependent markets. Australia, for instance, is a big importer of things like diesel, which is critical to running their local economy. The reason that you're seeing this is because they have very low baseline inventories, 30 or 40 days. Most sort of consultants would say you need at least 90 days of inventory to be able to weather these shocks. So if you're right, what would happen is you build these inventories, then you realize we don't need them and you sell them all. But I think that we came into this with dramatically low base starting inventories. So what I would expect to happen is let's build the inventories and then let's keep it there. And it's not like you're going to have this glut that then gets sort of resolved over time.
Your point on production is well taken too. I've been tracking those rig counts in the US and almost no response, to higher oil prices.
Because, oil companies and oil producers, they do generate cash based on the prompt prices, but they sort of budget based on the futures prices. And so WTI prices in the US, they're up, but they're up like $10 a barrel. So maybe an oil producer's earning $100 a barrel today, but when they're thinking about what they're going to earn 12 or 15 or 18 months from now, it's 65 or 70. So one thing that you've seen with the commodity markets themselves is they have not sort of moved the whole curve up to invite this supply response.
So what would you say about the pullback in energy stocks since the war broke out?
Yeah, I'd start with, we're starting to see capital flows move. We're starting to see investors move, but I think this is still sort of a perceived small sector that you don't have to own. And if things are getting better, why not wait until the sort of the tea leaves look a little bit better? Secondarily, we haven't seen the futures curves rise. And so I think the equities are discounting the future. The commodities are sort of more talking about the present, and we do need to have oil price futures go higher for equity investors to say, well, there's a significant increase in the value here. Now, we think that will play out over time. I do think the futures curves are too low. The other thing that I would say, and sort of as I think about where we're going for energy versus where we've come from, a lot of people look at oil companies and energy companies and they say, well, they're trading at a high multiple relative to the last 10 years. So maybe the last 10 years they traded at 5 to 10 times EBITDA, and today they're trading at 10 times EBITDA. Why would I want to own a business there? How I would respond to that is I would say, for the last 15 years, oil companies were viewed as declining annuities. You take an oil producer, you're going to get 5 years of $100 of cash flow. You're going to get 15 years of cash flow declines, and then you're going to get zero cash flow after year 21. That is a very low terminal value business. And the multiple that you're going to sort of give psychologically to that sector is going to be very low. If all you do is change the mentality and say, hey, well, we're going to need oil for the next 50 years, it's no longer a declining annuity, it's a perpetuity. I'd say the valuation paradigm is dramatically different. We do think that's where we're going. We're exiting the sort of end of the oil, end of the energy era that kind of was here from, say, 2012 to 2025. And we're coming back not to a place where we need all this oil, we need all this growth, we need all this traditional energy, but hey, it's just going to be a part of the mix for a really long time. To us, that means that the last 10-year multiples don't really matter all that much.
Mm.
You should sort of re-underwrite and sort of think about what the future is going to be. And in that world, I'd say investors will chase, but they'll be willing to pay higher multiples over time as this sort of era of scarcity, energy addition world comes into play.
I mean, it's so funny because you can see inflation. It's really not just energy, right? You have copper prices, as you mentioned, moving higher, aluminum prices moving higher, soybeans moving higher, so many inputs, chemical prices moving higher. And yet, we got a read of inflation and it was high and gas prices featured and the market just kind of shrugged it off and was like, yeah, we're fine with it. We think it's transitory. Is that a disconnect? And do you think that like comes home to roost at some point?
I do. I mean, I kind of think investors often sort of wait and sort of chase. They want to sort of make sure that things are on the trajectory they believe before that they move. And when I say investors, I mean sort of big capital flows. You tend to see things sort of, hey, I'm okay to buy it up 15%. But I want to make sure that sort of the trend is in place. And so I do think there's a disconnect. I think the way we calculate inflation can be distorted in many ways. If you look at the, one sell side analyst group puts out what they call the common man CPI, that's very different from what the sort of published figures are. And so, no, I think, listen, for the last many, many years, it was equities are great. There's no need to own other things, and you always sort of buy the dips, and that's working here so far in the last couple of weeks. But for us again, as we think about sort of where the world is going in the future, we just think it's a very different. Even if it's not different, you should have more of the things that can protect based on just how things are shifting.
Where does gold factor in this conversation?
Yeah, gold's a really tricky one. So we talked about infrastructure, what we invest in. Obviously, natural resource equities, that's pure inflation beta, high total return, acts very differently. And when we think about natural resource equities, it's all metals, all energy, and all ag. What we try to do is do two things really well. We try to be commodity analysts where we're predicting commodity prices. And we try to be equity analysts where we say, okay, based on those views, how are the equities going to act? So we spend a lot of time thinking about supply, demand, elasticity, inventories, marginal cost to come up with, well, hey, where are commodity prices going to be 3 years from now? Gold is the one that, trades on very different things. So, hey, it used to just be dollar and yields, and then the model broke, and now people are looking at its correlations to other things. I guess for me, if you go back in time, there have been two major inflationary periods in gold, and each time that's happened, gold went up 300 to 400%. So it started at 100, and then it went to 300 to 400, and then it lived there for a while, and then it went from sort of 350 to 1400. So here we are today, gold 4,500 or wherever it is. You're kind of at the low end of what happens in sort of historical gold inflationary periods. I think that this has been a reasonable move. We actually think the equities are not discounting spot. We think spot prices can hold. So we do think the equities look particularly attractive. But, gold is, I think, the sort of risk-off diversifier that people have always relied on, and we think they will. And I'd say the move that we've seen here is very consistent with historical moves in gold. And we kind of like the equities that are very tied into that value chain.
What's your top kind of gold exposure, if you wanted to express that as an equity?
Yeah, I mean, today we really like the gold streamers because they have a lot more direct exposure to higher prices without any of the sort of inflationary impacts. So, a company in the gold streaming world that we like would be like a Franco, which is obviously a Canadian listed company, where we think they've got great asset base, great management team, and will be a beneficiary of even stable gold prices, let alone if gold prices rise from here.
Okay, well, we have a lot of questions about these real world and natural gas companies, so natural resource companies, I should say. So why don't we get into the mailbag? Okay, our first question in the mailbag actually is about an energy company. Thoughts on companies like Suncor and how it will respond to oil prices. This one coming from Mohit.
Yeah, very high level, we really prefer the business model of the oil sands over the business model of U.S. shale.
Tell me why.
U.S. shale is a good asset, but it is highly depleting and highly capital intense. So you drill a well, you get 100 barrels this year. Next year, you might only get 40. And to maintain production, you have to reinvest a lot in the shale resource. And so we think that is a okay business model when oil prices are rising, but it obviously can be very high beta to just movements in oil. And again, we think very capital intensive and potentially very impacted by inflation. Oil sands broadly are kind of very different. It costs a lot to build an oil sands mine, but then you can run it at a very low variable cost, and they have a long-term inventory. So one thing, if you remember sort of the analogy that I went through a couple minutes ago about, we're at the peak oil age and we're going into the sort of oil is going to be valuable. With the oil sands, I think one of the big differentiators they have also is very long inventory lives. In some cases, they've got 30 or 40 years of oil production behind their mines. 5 years ago, you're kind of like, well, I don't want to ascribe any value to an oil barrel that's going to be produced in 2040 because we're not going to need oil. And obviously, part of our case is, well, that's changing. Oil that's going to be produced in 2040, 2045, 2050 will have some value. And so oil sands, Suncor being a great example, we think are those better oil business models with long inventories that are going to be the best ways to accrue the value from the sort of strength in the energy cycle. In terms of what are they going to do, I think that management teams are going to stay very disciplined, and it's going to be about very modest reinvestment in CapEx to increase production, but it's really going to be about maintaining production levels, generating a lot of free cash flow, returning that to shareholders, maybe opportunistically looking at things, but really sort of taking advantage of where we are in the energy cycle.
So just like a really simplistic question, oil's gone from like over $100 a barrel. Today it's at $90 a barrel. If it settles out at $80 a barrel, you can argue, yeah, that's a nice life for Suncor and the others, but it's still lower. And don't these stocks just trade in line with what crude prices are doing?
They do in the short term, but what I'd say is, again, we think that the futures prices are going to have to rise. So we think the average oil company is discounting something like 65 or 70 today, and they probably should discount something like 80. And so if we go to 80 and we stay there, we do think that in the long run, the value sort of creation will be there. And then secondarily, I think it's that multiple expansion opportunity from terminal value realization. And so in the short term, all energy companies, if you tell me the price of oil, I'll tell you what energy companies are going to do with 95% confidence over the next month. But it's more about, hey, get past the sort of tail wagging the dog of commodity prices and more about, well, what's being discounted today and what really should be discounted.
Suncor being more integrated, we often also get questions about Canadian natural resources, which, a lot of people don't realize also has natural gas exposure. Do you have a preferred expression on how you want to play your thesis in structurally higher oil prices, like integrateds versus pure plays?
Yeah, here and now, we prefer integrateds over sort of pure producers, just because we do think that these. So again, there is only one customer for an oil barrel, and that's a refinery. And so you can't do anything with oil until you refine it, and then you turn it into gasoline, diesel, jet fuel, and other products, and you sell those. One thing you've seen with the Iran conflict is obviously oil prices are up a lot, but the product prices are up way more because diesels was actually as scarce in many markets and so forth. And so here and now, we think the opportunity is superior in the integrateds because they're going to capture more of the sort of scarcity-led dislocation. And so I think there's a lot of oil companies act very similarly, but if you're thinking about, hey, do I want to be a pure producer? Do I want to be integrated? Do I want to be downstream? Here and now, the integrated model we think is the best place to be.
So a follow-up question, we got a question on Valero. This question from Calvin, what do you think of Valero, which is a refiner?
Yeah, I mean, similar with integrateds, if you think about energy markets, you've got upstream, which is just the producers of oil and natural gas. You've got midstream, which are the pipeline companies. You've got downstream, which is the refiners. They're converting the oil into gasoline, diesel, jet fuel. Integrateds have the whole value chain, and then the service companies on the side are making sure that everything operates. Valero being a refiner, they're going to be sort of exposed to the crack spreads and the higher diesel prices and the higher gasoline prices. So I think here and now, midstream is the least interesting. Producers are the second least interesting. Integrateds and refiners are the most interesting. And then oil field services, we think that there's some interesting opportunities there, but it's going to be a lot more differentiation. So definitely feel like being integrated or downstream here and now, given valuations, is the place to be.
Well, that leads us to a question on TC Energy, kind of a staple name, the former TransCanada Pipeline, TRP, on the TSX. Had a really nice run before crude oil. Maybe you want to spend a moment on valuation here too, on the pipelines, but how do you think about owning the pipes here?
Yeah, it's like asking me, well, which of my children's the favorite, right? And I started my career as a pipeline analyst, so TC is near and dear to my heart. Great company. When I say sort of looking at the energy value chain, sort of midstream is low on the stack, It's because it provides something different. Like from an infrastructure investor perspective, we actually really like midstream today. So natural gas, we think, is a key bridge fuel. We think it is critical for data centers, AI, electrification, power growth. We really think nuclear is going to continue to be a resource that accelerates. TC Energy has a large nuclear fleet in Ontario. So it kind of provides a very different thing than you get from sort of an integrated or a producer, which is probably like lower expected returns versus those, but obviously lower volatility. So from an infrastructure investor perspective, we still really like those businesses. We think the natural gas demand growth is going to accelerate. When I think about investing, a lot of times it always comes back to supply and demand. So for someone like TC, who's predominantly a natural gas pipeline company, you can think about their asset base as being demand for pipelines, being natural gas production, natural gas consumption, and then supply is, are we building new pipelines or not? We think demand for pipelines, we think demand is going up because supply is increasing and sort of the consumption of natural gas is rising. It's still really hard to build gas pipelines. So the supply of pipelines is not keeping up, and that's going to give them really good pricing power. And so again, it's like a very different reward, risk return. But we think even after the very strong move, they're going to continue to see strong growth in the gas pipeline side.
Because you started out as a pipeline analyst, I'm sure you know the drama about getting a new pipeline approved in the U.S. and definitely in Canada. Dare you make a call on whether you think that's happened, whether the political winds have shifted and making it more favorable? Is there even a way to play that right now? Do you see a world in which any of these companies want to step up to finance that?
Yeah, so we'll talk about my favorite acronym. So 10 years ago, we were in a NIMBY world, which was not in my backyard. I don't want the infrastructure built around me, but yeah, sure, go a couple towns over and maybe you can build some there. Starting like 9 years ago through today, we think the world shifted to the bananas world, which is build absolutely nothing anywhere near anything. So it's actually way worse than NIMBY because it's not only do I not want it there, I want it nowhere. On like the margin, we're moving from bananas back to NIMBY, but we're not in a build it all everywhere. Let's sort of get permitting reform and let's rock and roll. A lot of permitting happens at the state and local level. There still is quite a bit of pushback. Companies saw massive inflation in the cost of building new projects that really caused a huge erosion of stock prices and returns. I think, they've learned lessons. Banks are less willing to finance things. So versus 3 years ago, is it slightly better? Yes. But are we sort of in the equivalent of drill, baby, drill for pipelines, which is sort of build pipe, baby, build pipe, I guess.
Doesn't roll off the tongue as much.
Yeah, we're not there.
All right. Well, that's a good explanation of all the dynamics beyond just, the political will to do so. You've talked a bit about nuclear. We got a question on Cameco. I actually interviewed the CEO of Cameco, Tim Gitzel, and he said in his 40-year career, he's never seen better dynamics. And of course, he weathered the worst of it post-Fukushima. Cameco's come off a little bit. He talked about how Iran generally, he's maybe getting a little bit more phone calls about creating nuclear, and reactors are definitely set to grow over the next couple of years. How do you think about expressing that through owning a company like Cameco?
We love nuclear generation. We sort of think that we are in a nuclear renaissance. Now, when I say nuclear renaissance, people say, oh, okay, Tyler, does that mean we're going to build a bunch of reactors tomorrow and suddenly we're going to be in this sort of all nuclear world? No. We think it's a 4-phase build out. I mean, take a step back. So why are we even talking about nuclear? If you break so we think you need more energy. We talk about this as an energy addition world. If you agree with us on that, then you'd say, okay, I have 2 types of energy that I can get. I can get traditional energy, or I can get alternative energy. Traditional is good in that it can run 24/7, 365. It's what you call base load. It's predictable. Unfortunately, it has emissions that we don't want. Alternative is good in that it's clean, but it doesn't run 24/7, 365. Sun doesn't shine, wind doesn't blow, you're not generating power. Data centers, they need to have power 24/7, 365. Electrification is all about consistency and predictability of power supply. Nuclear is the one resource that can kind of sort of bridge the gap because it is base load. It's the highest capacity factor, 24/7, 365. It really runs predictably, and it's really clean. You have spent uranium fuel, but besides that, it's a pretty good resource. So that's why there's so much excitement. We think we need the power, we need the predictability of power, and we want it to be clean. And nuclear is sort of the resource that does that. Now, what's happened for the last 20 years, again, sometimes I think in very long cycles, as you can tell, but the last 20 years, the world shut down a lot of nuclear reactors. So phase 1 of the nuclear renaissance is let's stop shutting things down. We think we're at the end of that ballgame. We're at the 8th inning. We're not shutting things down. Phase 2 is, well, let's turn on things that we can turn on that we shut off recently. We're in the 5th inning there, in the US, where we're turning reactors back on. That's going to start to bend the supply of nuclear generation up. We think that's going to start to hit in the next couple years, and that's sort of the sort of playbook now till 2030. From 2030 to 2035, it's going to be about increasing capacity factors. Can you do new builds within the fence at existing facilities? Some brownfield growth. We think that's going to accelerate. That's 2030 to 2035. Post 2035 is the SMRs, potentially the new technologies, the new large-scale reactors, which we do think will happen, but it's going to be a long tail. In that world, we think uranium is really cheap today. We think uranium prices have to go up a lot.
How much? It's around $85, right? A pound?
Yeah. There's a difference between spot market and the term market. Just uranium to me is one of the most interesting commodities to talk about because we spend a lot of time thinking about demand elasticity and supply elasticity. So let's start with demand elasticity. The consumer of enriched uranium, but let's just say uranium, is completely price insensitive, right? A utility or other owner has spent $10 billion building a nuclear reactor, of which the fuel is a pretty small cost, and that reactor has zero economic value if it does not consume the uranium. So you look at that and you say, okay, they have to buy it to generate any economic value. It's somewhat of a small cost, zero demand elasticity. And that demand is growing as we turn the reactors back on and we build new ones. On the supply side, uranium is a tough thing to mine. It's been very concentrated in some regions over the course of the last couple of years. It takes a really long time to permit and build a new mine. Bananas issues in mining is similar to bananas issues in pipelines. And so we think it takes 7 to 10 years to build a new uranium mine. Now, uranium supply and demand is pretty balanced in the next 2 or 3 years, but the deficit starts to show up in 2030, 2031, and it's not going to be sort of solvable by increasing mine supply in the short term. So that to us means uranium prices have to go up. If you force me to put a number on it, I'd say it's going to be greater than 125. But that's I can't tell you when I think that's going to happen. It's just as we look at the marginal cost of uranium mining, uranium producers, and what you need to sort of greenlight a new mine, we think it's at least 50% above where current spot prices are.
In some ways, there's a scarcity of ways to play uranium in the market. So some of these stocks might be benefiting from that. But, take a Cameco. How do you go about, or how do you think about valuing a company like Cameco, which is a miner, but also has, that joint venture with Westinghouse, which is a builder, and consulting on creating some of these nuclear reactors. But is it looking at the multiple? Is it looking at the enterprise value to sales? Like, what is the right way? And tell me why it's maybe not overvalued.
Yeah, I'd say generally with sort of commodity businesses like this, or sort of these asset-heavy businesses in the natural resources space, we think it's important to take a mid-cycle view. So, hey, don't necessarily look at the multiple today relative to the history. Take a stand on what you think uranium prices are going to be in the future. Take a stand on what you think their mid-cycle volumes are going to be and the durability of those volumes. And then you can sort of DCF that into what you think the uranium production looks like and how much you pay for that. And then on the sort of the Westinghouse side, I mean, it's a business that is going to be very levered to CapEx increasing in the nuclear industry as we build, refurbish, and maintain nuclear assets. And so you can look at engineering and construction companies as proxies there to see how those stocks are trading and how they're reacting to similar trends as it pertains to electrification and so forth. And so for us, it's about, take a stand on what you think the commodity is worth and value the commodity business that way, and then take a stand on what you really think the TAM of the sort of construction side is going to be, and how much of the
total addressable market.
Yeah, total addressable market. And for us, again, we're very bullish on both the uranium side and the just sort of CapEx and investment opportunity in nuclear broadly. And we think that there's a long runway of growth.
Okay, so you don't think it's overvalued? I'll say
nothing
it.
that I give is ever investment advice, but no, it's
Yes.
if you were to look at our portfolio, you'd see that we have a holdings in Cameco across many accounts.
Okay, compliance will be happy, I hope. I've got a question on TransAlta. TransAlta has come off a little bit. There's excitement about how much it could grow as a result of data centers. It seems like it fits right into your invest in real world assets. A utility company. How do you think about TransAlta and where it fits in your, you don't like to look a year out, but in your 20-year view?
Yeah, I mean, part of our view is we think demand for power is rising and it's really tough to build new power. There's going to start to be big pushbacks because of affordability. Utilities are being asked to spend $1.5 trillion in the next 5 years. So if you have existing generation, we think that's going to be valuable. If you're in a market that is sort of cold in the winter where it's easier to keep data centers cool, we think that's going to attract investment. If you are invested in a domestic economy where the local government is trying to incentivize data centers and other sort of industrial customers to move into your region, we think you're going to be advantaged. So they're a great example of a company that has sort of existing power, existing assets in sort of a good geographic region that should benefit from a lot of the trends that we've talked about.
I ask a lot of our guests this, but I feel like the estimates are so all over the place about data center demand. Do you have a number of what that looks like? Like when you're investing in these utilities, that's become like the new proxy AI trade. How do you make sure that that the amount of demand that's being priced in is actually going to manifest?
So one thing that we're spending a lot of time on is sort of looking at what the hyperscalers are doing from a CapEx perspective. And every single quarter, they've been revising CapEx higher, not just in the short term, but also through 2027. I mean, there's one example that I'll give you, which the numbers are so shocking, but let me walk through it for 30 seconds here. There is a utility in the Midwest in the US that was founded in 1880. They currently have a peak generation capacity of 11 gigawatts. So 1 gigawatt is the amount of power you need for a 1 million person city. In the US, I talk about that as the city of Denver, but whatever the equivalent 1 million person city in Canada would be. So from 1880 to 2025, they built a generation backlog of 11 gigawatts. They currently have customers asking them to build 15 gigawatts.
Wow.
So you are at a gigawatt a decade growth rate, and you're at like a gigawatt a quarter request list. That's massive. Now, it's not all going to be built. It's going to be very inflationary and so forth. But as we look at it, these trends we think are structural. The channel checks continue to say that the sort of demand for power is accelerating. It's not all data centers. As we look at demand growth over the course of the next couple of years, half is data centers, but half is from EVs, industrial demand, other demand as well. And so, when you put all this together, we think, electricity demand growth is going to rise about 3 or 4% a year for the next 5 years. That doesn't seem like a huge number. That's up from zero. So 2007 to 2022, there was zero electricity demand growth in the U.S. That's going to step change up to 3 to 4% the next couple of years. That's a huge opportunity. It's a huge challenge. Going back to infrastructure, CapEx investments are great for utilities, or they're horrible because someone has to pay the cost of it. And so we're spending a lot of time understanding local regulatory frameworks and outlooks, because some utilities are going to really benefit and some are going to really struggle with all the CapEx required for these things.
Our final question in the mailbag before we get to your pro picks, real world assets, we got to talk about rails. Which have been a complicated area for some investors. There's been M&A. We got a question, thoughts on Norfolk Southern and its proposed deal with Union Pacific. This one coming from Harry. How do you think about, does the deal get approved, what it means for the railway sector in general, and maybe just the thesis for owning rails in the portfolio?
Yeah, it's really hard, obviously, to predict regulatory outcomes. What I would say is 3 years ago, the possibility of rail M&A was zero. I would have said, we're sort of stuck with the sort of rail system that we have post the CP-KSU merger a couple years ago. We started to see some signals last year that the STB here in the U.S. Maybe was going to be more receptive to rail mergers, because it's less about rail on rail competition and it's more about rail versus trucks and rail versus other forms of transportation. We think that there is a huge value unlock opportunity if rail M&A were to happen. Basically, the rails are still somewhat inefficient because they all get to the middle of the country and they have to interchange, and there's a lot of sort of waste and slowness that happens. So if you were able to get down to 2 or 3 transcontinental railroads, we think that that's very margin enhancing. In the long run, we do worry, for what it's worth, about autonomous trucks and what that could do in terms of a competitive threat to rails. But if the M&A does get approved, we do think that the sort of margin improvement story is pretty attractive. And here and now, we do think that there's a high probability that it happens, obviously knowing that sort of regulatory outcomes are a hard thing to measure and to handicap.
Are there more deals to be done if this one gets approved?
I really don't see a world where one transcontinental railroad goes through and you don't have another. So I do think if this happens, it's likely that there will be further consolidation behind it as well.
Okay, we'll watch. Let's get into your pro pick, some of your high conviction ideas. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information.
Yeah, so the 3 that we're going to talk about here, so one is a company called MasTec. So a lot of what I've talked about over the course of the last 40 minutes or so has been our excitement about the investment opportunity in infrastructure and in the natural resource economy. We need to build more transmission lines. We need to build some more pipelines, as we talked about. We need to build more fiber. So we really like companies that are participating in the value chain. You could think about that as the sort of picks and shovels of the electrification build out.
Let's start with MasTec. What a beautiful chart. Just up and to the right, up like 65% in 2026 alone. What's got everyone so excited about this infrastructure play?
Yeah, the CapEx for all infrastructure companies around the world in their end markets is accelerating. And so They are basically a service provider to building all the stuff that we've been talking about, helping build the power lines and everything. So when I think about sort of stock price that goes up a lot, generically, it's is the revenue accelerating? Are the margins accelerating? And is it becoming more predictable? Is it becoming a better business? And that's how you get sort of multiple expansion. I'd say with all of the engineering construction companies, which have similar charts, we're seeing, revenue opportunities grow. These businesses are getting better. They're becoming more predictable. And that's sort of led to a strong re-rating in a lot of stocks that, again, if we're right in terms of the build out of all the things that we've been talking about here, we think it's going to be a multi-year opportunity for really strong growth.
I mean, the growth at Mastech has been stunning. 2022, like sub 10 billion revenue, and by next year it'll be 18 billion. If consensus is right, is the risk if some of these hyperscalers stop spending? Or if CapEx starts to go down?
They're going to be companies like this are going to be very exposed to the aggregate amount of CapEx in, the utility economy and the industrial economy. And so if you run into a recession where you start to see CapEx get rationalized, clearly that's not going to be a good thing, at least in the short term. The other thing, if you kind of think about what these businesses provide as a sector, it's sort of specialized labor that is becoming more scarce. And so you just think about what you're offering as you're going to customers and you're saying, you need specialized labor, welders, electricians, and so forth that can sort of lay the power lines and build the assets and the generation plants and the pipelines and the fiber. Demographics would say that labor is becoming more scarce over time. And so what you're sort of offering your customer is a thing that's going to be more valuable into the future. And I think that's also a big driver of why they've done well, but why, they companies like this can continue to do well over time.
Your second pick, ConocoPhillips, I think that's interesting. Just did a deal with Marathon. You said you liked your Canadian producers, but it sounds like Conoco's got a piece of your heart as well. So, talk to me about where Cameco fits for you.
Yeah, for us, it's part of the thesis of who has invested countercyclically, who is sort of positioned to start to see free cash flow accelerate based on where we are in the cycle, and then who's got a long inventory of growth. And so we really love the oil sands for those reasons, less about the investing countercyclically, more about the long inventories. But Conoco was one that sort of was penalized for a while because they sort of spent through the down cycle. But given where we are in certain terms of global oil and energy trends, we think a lot of those investments, which will start to cash flow in the next few years, are going to be rewarded by shareholders. So if you just think about our energy thesis today, a lot of it revolves around who has a lot of oil in the ground that can be converted into dollars in the next 20 years, because the oil in the ground is probably underappreciated by the market. And someone like Cameco, we think, fits the bill really well there.
So they bought Marathon a few years ago, 2024. Are they still in the process of realizing the benefits? Like, are there some, they use the word synergies?
Yeah, we think there's sort of a lot of synergies in consolidation across a lot of these industries. That's a great example of one where, there were a lot of independent oil producers, oil companies in the U.S. You start to put them together, better engineering, less G&A, better capabilities and so forth. Usually takes a couple years to really sort of see the manifestations of all that benefit. And we think that they've generally been good executors over time.
Okay, your third pick is interesting. I'll call it your spiciest pick because it's a natural gas play, and depending where you're selling natural gas, it can be a bit of a heartbreaker. Tamboran has certainly seen volatility, and I think that's around the Iran war. But talk to me about Tamboran Resources. First, because it's not household, what's the exposure that you're getting here?
Yeah, so one of the sort of preeminent shale wildcatters is one of the sort of key sponsors. It's a publicly traded company in Australia that is trying to develop what's called the Beetaloo Basin, which is a new shale gas basin in sort of northern Australia. It is definitely still at the somewhat science experiment phase where they're going and drilling new wells. but they've spent a lot of time on the engineering and geology and think that the resource in the ground is going to be very prolific. And so you're in the, can we create value by drilling wells and sort of proving that there's a lot of resource under the drill bit phase, which I definitely agree that it's a spicier pick. But taking a step back, again, our view on sort of how things are changing, we think you need more production of natural resources from more places around the world. Australia is a place that historically was a large energy and gas producer. They've let a lot of their fields sort of decline over time. They could be a large LNG supplier to the global economy, but they need the resource in the ground in Australia to feed the LNG export facilities. So this would be an example of a company that we think from a geopolitical, energy security, energy stability perspective is in a really good market. Australia is short natural gas. They don't need to be as a country. And so to the extent that the geology there is attractive and the sort of well economics are good, you can think about that as sort of like the next really attractive shale basin. There's stuff going on in Argentina. There's other places where these types of activities are happening. We just think that that's a particularly unique opportunity.
And do you think the catalysts are near term? I mean, it's kind of like, their exploration, sub $1 billion market cap. How long do investors, do you think, have to wait around for some of these explorations to bear fruit?
Yeah, I mean, they're in the pilot drilling process today. So we will get well results over the course of the next 2 quarters or so, which will give the market a lot more information in terms of the possibility of success there. So we think about it, or I think about it as sort of like a long-term opportunity to the extent that they're able to be successful developing this basin. But we'll see over the course of the next few quarters some data points in terms of how that's progressing.
Do they have the liquidity? When you're talking about these exploration companies, like how is their financing position to kind of do this?
They did just raise equity a couple weeks ago. So they have some sort of fresh equity in. And then I think a part of their business plan is to partner up with larger global integrated players who are kind of circling around Australia and other places. And so I think if they're able to be successful with some of their well results, their ability to sort of raise the financing they would need to sort of develop the business, could definitely be there.
How often do you do this? Is this a common kind of stock that you would kind of tuck in? Because we've talked about some huge, major, multi-billion-dollar companies that have existing businesses. How often do you get speculative?
For us, we are thematically informed relative value investors, where we're trying to figure out, hey, what are the best themes, and then what are the best ways to represent those themes? We are active. If the best opportunities are in large cap household names, we'll go there. If we find a unique opportunity sort of turning over some stones somewhere, we'll go there as well. So I'd say core to our process is trying to unearth things like this. And we think that's sort of a big reason that active management can really matter in these sectors, because, you can make a lot of really good investment results in large cap stuff, and you can also find some really cool things around the world if you've got a team that knows how to look for it. And so sometimes these are big parts of the portfolio, sometimes they're small parts of the portfolio, but I'd say we're always on the hunt for great ideas.
All right, Tyler, it's been a pleasure. Thank you so much for joining us. We'd love to have you back on the show.
Thanks so much for having me.
This ETF Minute is sponsored by BMO ETFs. This is for general informational purposes only and not personalized investment advice. Markets move fast and the ETF landscape has to shift with it. To check up on the changes that have been made at BMO, we are checking in with Matthew Montemoro. He is the head of fixed income and equity index ETFs at BMO Global Asset Management. Thank you so much for joining me.
Thanks for having me, Amber.
So a number of changes within some of your ETF products, and this is just kind of a good time to condense what they are, because I know you guys have been busy over there. I want to start with what you guys have done in the bond portfolio.
So when we look at our asset allocation ETFs and we're looking at any sort of the rebalances, what we always want to look at is the totality of investors, both registered and non-registered accounts. And so knowing that our investor base in Canada 2/3 to 3/4 of investors have their investable assets in taxable accounts, we know that taxes are important to a lot of investors. So when we looked at the rebalance, we wanted to say to ourselves, if we're going to make a change, can we make or create a better outcome for a large percentage of our investors? So looking at that, we looked directly at the core of our fixed income portfolio. We looked at ZAG, the aggregate bond fund, and we said, you know what? We have a solution that's a little bit more tax efficient. It's ZDB, our discount bond fund. And what that does is it provides the same risk return profile, the same risk characteristics from duration to yield to sector to subsector, but it constrains the coupon, making it more tax efficient for the end investor. And what that actually means is about 30 basis points extra in your pocket after taxes. So we looked at that switch and we said, you know what? I think for a lot of our investors, this would be a better outcome. And there's no real downside for the rest of the investors who may be in registered accounts. So when we looked at our December rebalance for our asset allocation ETFs, we made that switch selling out of ZAG and into ZDB.
And those ETFs you can still buy separately.
Absolutely.
But in the asset allocation ETF, you're now getting the ZDB, which gives you that exposure, better, more tax advantage exposure. Another way that you're looking at kind of client behavior is with respect to what's going on in commodities. There's no denying the momentum that we've seen in gold prices, a little bit of volatility sometimes, but definitely momentum. And people are looking for access to this area. You guys, I'm sure, have this gold ETF that has seen a lot of flows, and you've changed the pricing on it.
Absolutely. So, this is something that I think is going to be a long-term strategic change for investors. And we're seeing this trend happen live in markets right now. We are seeing investors look at that gold price, all the way up to 6,000, coming back down to, 48, 4,700, lots of volatility, as you said. But we're seeing investors say, I want to add allocation to gold over the long term. And so we're seeing them carve out their balanced portfolios a little bit from their equity side, a little bit from fixed income, and adding gold bullion or gold exposure. And what that's doing is it's helping downside protection over the long term, but also allowing you to capture more returns. So it's a really winning trade from that perspective. And at BMO, we want to offer all sorts of opportunities in the gold space. So it's either the plain vanilla gold bullion, which is the cheapest in the market. We can give you something called ZWGD, which is our covered call spread, allowing you to extract cash flow from that gold bullion. Or from what we just cut our fees, our junior and senior gold miners, giving you a little bit more torque in those portfolios. And again, what we wanted to do is look at the suite and say, we want to be investors' choice and go-to for gold products. And now we are the lowest cost across the board, and you get a full spectrum of gold exposure. If you have ZGD, which is our senior miners, and if you have ZJG, which is our junior miners, both cut to 40 basis points, the lowest cost for equity gold exposure.
You guys have actually been cutting fees kind of across the board. You have these all-in-one ETFs, which, again, so much interest recently. Talk to me about the trends that you're seeing in all-in-one ETFs and then how much you've lowered the fees on those.
Absolutely. So this is an area where, the last couple of years we've seen do-it-yourself investors look to these asset allocation all-in-one ETFs and look for that one-stop solution. And so, earlier this year, we cut the fees, lowest cost in the industry at 15 basis points. You're getting exposure to global equities and fixed income, over 6,000 stocks in terms of diversification, getting exposure to Canadian, US, global bonds, which is difficult for the average do-it-yourself investor to get. But what we're seeing is it's not just a one-ticket solution for every investor. A lot of do-it-yourself investors still want to take idiosyncratic risk. They still want to pick and choose the stocks of their own. So what we're seeing growing trend is using those asset allocation ETFs as the core and kind of using an core and explore model. So using that, maybe it's 5 or 10 individual names, complementing that core exposure, and then using those individual names as a satellite-like approach. So that's something we're seeing increasing usage in the do-it-yourself channel.
It's interesting talking about these fee cuts and kind of shifting exposure to make it tax advantage. This is an industry, it's quite competitive. As you know, so what's the impetus? Is it all about kind of growing assets? Is that what's driving the fee cuts? Is it competitive? Is it strategic, operational? How do you think about, the rationale behind some of the moves you've made?
For us, innovation is in our DNA. Since we launched ETFs in 2009, we've always wanted to innovate, and we always come back to, can we solve an investor problem? Sometimes that's cost. Sometimes it's offering the lowest cost solution possible. Sometimes it is, is there providing access to a market that may be more challenging, whether that's fixed income, something like gold bullion, or it's solving an inherent challenge that investors have. So an example, I had said ZWGD, our cover call spread gold bullion product. One of the shortcomings of owning gold bullion is that it doesn't generate cash flow for investors. And if you're an investor who needs cash flow from their portfolio, allocating 5%, that may lead you to a shortfall. So what we've been able to do is look at it from a cover call and an option-based approach and say, well, we can use the volatility of gold and monetize that and then provide that cash flow to investors. So for us, it's always looking at trying to solve an investor problem, whether it's cutting fees so that you can get it more efficiently, or whether it's launching a new novel-like approach like ZWGD and providing an exposure or cash flow from a segment of the market that wasn't possible prior.
Matthew Montemaro, thank you so much for joining me on this ETF Minute.
Thanks, Amber. It was great.
Coming up on our next show, we've got Mark Robinson of Fax Capital. This is the firm that is backed by Sean and Blair Driscoll. They sold Century to CI Investments, and now they've set up Fax, which is kind of interesting because it traffics in both public and private investments. On the public side, it tends to be kind of those smaller, more mid-cap, nuanced ideas, which I know you guys love. So if you've got any questions on that, you can send us an email, questions@inthemoneypod.com. Find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.